everyone. I know I'm just standing between tea for you all. I know all of you must be very sleepy by now, but we'll try to make it as interesting as we can. So our panel today is discussing about value versus valuation. And a lot of times, I think a lot of us really think about what's the real difference, right? So I wanted to address the elephant in the room. How do you really define value, right? And I want to take opinions from our esteemed panelists. How do you really define value, Abhishek?
Starting with me?
Yeah.
That caught me by surprise. So how do you define value, right? It's a very interesting question, and I can answer it from our perspective at Cornerstone, because we're a B2B focused fund, particularly investing in SaaS, which is his favorite domain. But for any founder, entrepreneur, if I look at it from that perspective, it's really what's the impact you're creating for your customers, and what is the extent of that impact. You can define it in a quantifiable way as top line impact, bottom line impact. Are you really becoming core to the business of your customer? For me, that defines the extent of value you're creating. If you're a fringe benefit, you're a frill, which is good to have in tough times like the recessionary environment, I can easily log out of any such expenses. That, according to me, is not valuable at all, right? You need to own the process. You need to own the transaction. I'm talking from, a product or innovation that you're building for enterprise. And if you're able to do that, that's where maximum value is actually created for the customer. And for me as an investor, that's what matters when I actually look at how valuable is this technology. If you look at it from a zoomed out macro perspective, and all we can talk about is unicorns and billions of dollars and how many consumers. And the one thing that I think is important to address for the Indian market, when you look at, I'm building something for 1 billion people in India, and a lot of, in the beginning of our ecosystem, between say 5 to 15, most of the global investors saw this ecosystem as, here's 1 billion consumers, your GDP per capita is moving up by $1,000 over 10 years, and that's $1 trillion of consumption. So what's worked in the West will work in India, and they just copy-pasted those models, parked hundreds of millions of dollars behind that, but the nuances of the Indian consumer are that it's a very value-conscious consumer, right? So if, in my view, one should not attribute the valuation that an investor gives to the potential opportunity as the value of that business. Right?
Got it. You actually spoke like a true investor, mostly focusing on the finance bit of it. But I think Latika may have a different point of view. And I want to emphasize on the fact that entire day we've been talking about sustainability, ESG. How do you bake that into valuation value? Is it really just the EBITDA, or are we talking more about creating shared values, a stakeholder value versus shareholder value? You want to throw some light on that?
So, on my way here to the conference, I spoke to Anjali Bansal, who is of Avana Capital. And her focus is really on companies creating value in the space of clean tech, agri-tech, food, and really solving the food problem here first in India and globally. Clearly, this fits into the entire ethos of the conversation we had earlier in terms of climate concerns, food concerns, etc. At the same time, she was very, very clear. I am going to invest in businesses that are have an EBITDA. I am not a not-for-profit giving out grants. I'm going to invest in businesses who create value, right? And that is really, I think, what any investor does. I think we cannot confuse the fact that maybe, there is an impact investor who may have a little bit a longer runway, in terms of saying that, okay, we expect you to get profitable maybe in year 6 or 7 versus maybe a typical investor says, I would like to see better numbers coming in year 3 or year 4. So value is absolutely important regardless of which sector you are investing in. So that's something I want to make very clear to people, to saying that either you're getting a grant or you're getting a check where investors expect returns.
Got it. I think interesting point of view, and I want to come to the topic that we had, value versus valuation, right? Now, one example that comes to my mind is Tiger. They did about more than 300 deals last year, which is almost a deal a day. How do you, in that kind of environment, and Prasanna, I would like to take your opinion on it, because you are also in a similar construct where you have an accelerator program where a lot of companies would come in, and especially B2B startups. How do you really differentiate between value and valuation? Do you tell startups to really go and run after valuation for the next round and the third round, because most of your would be seed-funded companies, or really build long-term value, right? And especially looking at the last 24 months of high liquid environment, everybody was running after higher valuation, higher multiples. Now you'll see more muted multiples and all of that. So how do you really kind of decimate the two?
Yeah, so I run an accelerator. We help B2B SaaS founders grow faster. The thing with B2B SaaS is it's very boring, right? So most of the people in this room will understand. Most of your businesses serving enterprises, or you're buying software, the stuff that you buy and use, it's like boring. If you go and talk to your families, they're going to be like, please stop, right? Let's talk about Paytm or something fun or IPL or something else, right? It's all boring. So for most of the founders that I work with, they're all like older. They're in their 30s, 40s, somewhere in their 50s. And so they've seen this whole circus go round and round, right? They know that what goes up from a valuation point of view will come down, right? And there's no like rhyme or reason to it, but you have to survive it. And so for most of the founders, and I was giving you an example earlier, as one of our startups, he's an ex-Toyota guy. He sells software that garages use in their operations. Really boring. He's making money, right? But boring. 2 years ago when he went to investors, or 3 years ago when he went to investors, they're like, can you make money in this business?
Right.
So they didn't fund him at that time. 1 year ago,
fund him now.
They didn't fund him. Now also they're not funding him. Right? So for him, there's no change. Right? Up, down, doesn't matter. See, all these up, down trends happen in cool stuff. B2B software, all of these people know as well, is really boring. Right? Nobody wants to invest in it. So the advantage there is that in the boring stuff, if you peel one layer and you start looking at it more deeply, then you come to, hey, are you adding real value to your customers' lives, like Abhishek was talking about? And is that sustainable value over time? If you can do that, then you can create true value in the business. The difference is, we'd say, I don't talk about valuation versus value as much as vanity versus value. So that's why we say no vanity SaaS. So there are too many businesses that have burnt $100 of equity value to create $1 of revenue. That's a vanity business.
Got it.
Serves some people's popularity well, but that's a shitty business to build, right? What we find in B2B SaaS is there are folks who are building completely bootstrapped $5 million ARR businesses with $3 million profit. $5 million revenue, $3 million profit with not a single dollar of external investment. That equity is real value.
Understood. Yeah. With that, I think that's a perfect segue to come to you, Mohan. And you've seen multiple downward cycles and boom and bust cycles. Last 24 months, we have seen phenomenal investments both from VC market, private equity market. But I think all of those waves are now hitting the downward trend, and there are uncertain environments, be it a geopolitical war scenario, inflation, rising interest rate. We all know what happens to asset prices in that kind of an environment, what happens to multiples. What kind of advice, or if you have to kind of highlight 2-3 bullet points that founders should watch out for, or even investors should watch out for in these kind of environment?
Absolutely, you're absolutely right. Last 18 months has been an aberration. so far. But I think it'll go back to the most fundamental aspect. So I've been in investment for last decade, first with Norwest and with Avatar now, the growth stage fund. Seen companies raise seed capital, Series A, Series B, Series C, D, E, F, and get stuck. Okay? So I think as a founder, you got to ask yourself the question, what is that you're creating? Okay? Are you creating a sustainable brand? Okay? Which means it takes 20 years. Okay? Are you creating a profitable business? Which means you can do a profitable business for 1,000 crores or 500 crores, list an exchange, provide an exit. Okay? Are you creating a new technology? Okay? Are you doing a quantum chip? Okay? Which is pretty challenging. Okay? So as a founder, you need to know what is that you're trying to achieve, right? And the answer to scaling up, answer to exit, are different answers, okay? Depending on what you set to achieve, right? And that doesn't matter depending on whether the market is up or down. The market, you need to tend to look at a 5 to 7 year average in terms of valuation, right? I know a lot of people talk about SaaS, I'll just still bring it up. I would say if you take last 7 or 8 year moving average, SaaS companies would be valued between 8 to 10 times, okay? I know a lot of companies raised at 30, 50, even 100, right? As a founder, you should not get carried away, okay? I think it's a mistake of investors, not founders. The investor's job to educate, I'm giving you this valuation at crazy, but as a founder, can you sustain the valuation and deliver value? Okay, at the end of the, ask yourself the hard question, right? Today in Indian ecosystem, I don't see either the founders nor the investors challenge the founders to ask this question, What is that you're going to be 5, 7 years from down the line? How are you going to provide an exit to your current, the early set of investors, the late stage investors? I don't think anybody has an answer, okay? Look, I'm going to raise my next round, and probably the next round, and hope something magic happens, right? So I would say you need to go back and ask your question, what is that you're creating, okay? Brand versus a sustainable business versus technology. Then ask yourself questions. In each one of these categories, there are different answers. What is that? How am I going to provide the exit? What is that I'm going to, the first, most important thing you have is for your employees, okay? A lot of people have left jobs, come to you, and spend maybe 5, 10 years with you to build whatever you're building. Right? How is that you're going to enrich their lives at the end of the day? Okay? I think if you answer these questions, I think recession or not recession doesn't matter.
I'm going to ask a little bit controversial question. Whatever has been happening in the last 24, 36 months, every founder going after crazy valuations, do you think it's most of a founder's mistake, or it's also Series C and Series D investor's mistake who are ready to pay any amount of money and increase this expectation? Are you at fault, or is some of the startups at fault?
I don't think anyone is at fault here. Right? Sure. So my take, sorry to interrupt, but I really believe that India today, why are we sitting and worrying about the valuations that we've got? Look at the crazy valuations that happens in the valley, right? We are now getting some of that going on out here, which is actually a good thing. I used to talk to my China, counterpart in China at Microsoft for Startups, and it was really interesting that they would have unicorns, start in 6 months. The Series A was 100 million, Series B was 500, and of course that was a unicorn valuation in 9 months. So I would like to say that it's okay to a certain extent because India has reached some level of maturity finally. We're also talking about maybe 5, 10, 20, we're not talking about the hundreds of startups all getting crazy valuations, right? We are only hearing about a few. So I'd rather say that it's not a bad thing at all. To Mohan's point though, I think what goes up the point what goes up comes down. The only advice would be to say that is it sustainable and are you prepared for it to go down?
Got it. Would you agree, Mohan, with that?
I think it's cycles, right? Comes in multiple cycles. And look, I think I don't want to go into the valuation discussion because if somebody is willing to give you, it's like a home. Why is a home in PBCD costing 100 crores or 1,000 crores. It's a demand and supply, right? If there's more cash chasing the founders, yes, price will go up.
Yeah.
I think the founders should be conscious, look, what I'm getting, it's good for me, I take the money, but can I use the money to build a sustainable, what are we doing, right? That is the most important. So valuation will come and go, you take your money and then build on top of that, okay?
Got it.
The last stage investors will lose money most of the time. People who come in at crazy valuation, 30, 50, all of them are going to lose money, okay? But as a business, you're going to continue, okay?
Right.
Doesn't matter to you, okay? You still build your company. It's the investors who are going to lose all the money, okay? So why are you bothered? Take it, build it. Yeah.
Makes sense.
Yeah.
Makes
So
sense.
I would put the blame firmly on investors just to take a dig at the two of them, right? Because technically they are sophisticated investors according to the RBI, SEC, whatever it is, right? And so what I really find jarring is the hypocrisy, right? So 2 years ago or 3 years ago, it's like founders take more money because if you have more money, you can build faster. Then 1 year ago, it's like all your competitors are raising money, so now you raise money and you can, build a better business. And now it's like, hey, you need money for 36 months, so raise money and keep money in the bank so that you can build a better business, right? So, somehow, always, whatever the state of the economy, it's like raise more money.
Yeah, but Preston, I take your point, but I think it's like going back. It's like saying that somebody advertises and forces a customer to buy a product, right? I think it's the job of the guys who raise money to find right investment opportunities and push people to take money if there was. But I think to your point, and I've mostly been a public market investor, so my vantage point is slightly different. But I think from what I've seen, people really don't value liquidity as deeply, right? So in a lot of the valuation models, liquidity does not get the importance that it should get, and therefore, people get so carried away with private market valuations because they don't get mark-to-market enough and well enough. So when you look at the public side of the markets, I think it's very efficient. It captures some of these things exceptionally well. Like we've seen, one or two of this, like tech startups that have listed in the last 2-3 years, like double on the day of the listing. Now, if you looked at it from the outside, it sounds like, wow, markets really thought it was a deep discount kind of an IPO, which got traded up 2 times on the day of the listing. But truly speaking, it was a 600 crore IPO, too small for any investor to really build its sizable position in an IPO. So the only way to really build it, if you're sort of involved, is to pay up for liquidity and buy it in the market, which sort of moves the stock. And then if you wanted to sell it, it'll come down the same way. So now some of these stocks are coming down. It's just purely because you can't get an exit, and exit is difficult. So in the private market, these things don't get priced in because you can't trade it every day, right? Versus the public market. So I think if you go through some of what the public market's done over the last 3, 4, 5 years, or even 10, 15 years after the GFC, it's priced things pretty well. I was looking at, I could be wrong because I don't track this sector very closely, but like the SaaS space, right? Like if you take the top 90 companies globally, like about 3, 4 years ago, the average multiple was somewhere close to 20 times, right? Of all the top 80, 90 companies. The median was about 13 times, which means the dispersion was really wide, right? That average and the median has really merged in the last 12 to 18 months, which is sort of what happens when liquidity starts to tighten in any environment, in any asset class. So it's not very different on what you see in this space play out like everywhere else. The beauty of it, and I think we were discussing before this discussion, is that it's so nascent and it's so early that there's so much deep value you can create long term.
Yeah, I think you bring a very valid point on the overall public markets trying to, or not being in sync with the private markets, or they're always catching up to each other in different formats. And maybe whatever has happened in the last 6 months, I think not many people would be jealous with what you've been doing. So, and I agree. Our crystal ball is probably not as clear as what you can see from a day-to-day trading perspective. But how do you see the correlation between public and private markets, especially in the tech segment? Is it how do you rate that? Would the private market rate value more versus valuation, or the public market are kind of more inclined on the value versus valuation?
See, typically when liquidity starts to tighten, the spreads widen between private and public. I mean, I think that's just very natural market phenomenon. But I think what's more important to really analyze is what class of investors are you attracting to these companies, and what do you really want? So, and I think if you work, and a lot of people actually miss that boat because people obsess with valuation, right? So you're so obsessed about valuation that you forget whether you're partnering with the right investor over a long period of time. So if you went and say took money from a public market investor that's mark to market every day, that has a bunch of retail mutual funds behind them, for example, right? So you just come under pressure to sell when there is outflow, right? And if your performance starts to deteriorate, you obviously get there is stress on the fund, right? So you can't really sustain that position over long term, even if you like the company and there was value. So it really depends on what class of investors you attract and at what stages. And these exist even in the public market. The profile of the kind of funds you may attract to your company could vary. The only problem on the public side is that you can't always decide who your investors are going to be, because the market does give the opportunity to others to sort of build a position as well. Whereas in private, you get the advantage of deciding who your investors are because it's at your discretion who you allocate your stock to. So, I mean, right. in my opinion, private market is easier to manage than the public market.
Of course.
Yeah, I would like to add to that, right? So public market is Indian public market and US public market, right? So there are two options for companies here to go IPO. The US, what you have seen is it can sustain losses for a long period of time, okay? Like take Tesla, take Amazon, even after they've gone public, I don't know when they ever been profitable, okay? Still public market. So their market rewards creating sustainable brands, okay? Which futuristic. And whereas in India, if you look at it, it's not yet there, okay? It's still about profit and bottom line, okay? So as a co-founder, you need to think, where am I going to list? It's different, okay? You can't go to the US market with 100 million revenue and 10 million profit. It'll be a Me Too listing. Whereas in India, it'll be a great listing, okay? So you can articulate your vision and say, I'm going to be a market leader in a category, okay? And you got to be very articulate in your communication. People should know about you. That's the only way you create a big company. Otherwise, it will not sustain. Okay? It will sustain for a period of. In fact, you can sustain for a long period of time with losses, as long as you can create an image, okay, that you are a great. Like Tesla is a classic example. Okay?
Exactly.
And there are many more by that. In fact, if we take all the SaaS companies, Shopify, they don't make money. Zoom doesn't make money. And none of them make money. Okay?
Exactly.
But they have created, look, they are a market leader. I'm going to push the envelope. Okay? So founders going to the US market, you have to keep that in mind. Okay? It's not enough to do just profits. Whereas you think India, I think it's different. Okay? You should look at profit. There's no point creating a loss-making business forever in India.
Very interesting.
So Vaibhav, since you want some conflict. I think, yes,
I always love that.
agree with Prasanna that investors are to blame, but I feel behind that is the public market guys to blame. Right? They are the bad boys here, right? And just to talk about founder, the only way or the only reason I would blame a founder is if you see and you're getting an opportunity, you're getting a big check at a great valuation, why would you not take it? Of course, take it. But if you take that money and assume it's cheap money because you've actually given up your equity, right? That's your investment too. That money is for you to invest and not to burn. And if you're raising a lot of money and your thought process is that I got this cheap and let me just burn through it and show some growth and great, I'm this big guy, that doesn't work. If the founder is doing that, that's where the founder is to be blamed, right? And I'll come back to public market guys, why I blame them, right? So in layman terms, what happened through the pandemic? Nobody was going to Goa. Nobody was spending at restaurants. There were no parties to go burn money at. If you're a rich guy, you're flying in private jet, those were shut. So you had a lot of money. What did you do? You put it in public markets. That took the markets up. Your Sensex was 60,000, 61, 62, whatever the numbers were. Then the smart guys said, I'm not going to put money in this inflated market. It's going to crash, and overnight I'll lose 30, 40, 70% of my money. Where do I put it? Private. Mohan, take extra money. Abhishek, take some more money. Put it in your market. What do? Go to Prasanna's boring guy, say, take some money. Yeah. So it's these guys who really brought the money because they didn't want that overnight burnout, because this is a long product, right? Even if you value a company 3 times, 4 times more than what it should be today, since you're long, you're here for like 5, 7, 10 years, whatever, you will end up not losing money, right? You might make your 1.5x, 2x if you're a late stage kind of investor. So yeah, that's where he is. He's the guy for you.
No, I mean, I think I actually there's a good point there, right? And that was my fundamental point I was making, that the liquidity is easier to generate in the public market. So even if you had a view and you to exhibit it, you could exhibit it much faster than in anywhere else. So yeah, always the first casualty of any exhibition of view tends to be public markets, right? And therefore, and it's also in asset classes, right? I mean, some of these interest rate hiking scenario was, I think anyone could have called it like 3-4 years ago, right? It was just a no-brainer. And you knew this is coming, but yet people try to tighten and get onto that last leg. Everyone wants to get the best valuation possible. You stretch yourself. You don't, you could have raised cash easily and been a little cash surplus in this environment, right? So it was there to see. But I guess when, my experience and my view on this is that companies in general shouldn't obsess about getting that top multiple or the top valuation. Then you sustain and you make more money over the long term, because you just, and that's, it's even if you look at the Nike story, right? Or you look at any of these companies that actually was almost taken to ground because they couldn't raise cash. Great stories, great companies, right? So I think liquidity is key. You need to have, I think managements that don't worry about, am I going to be like the top richest guy in the top 5 richest guys? That's getting the headlines as we speak today about who's richer than the other. But I think that's very, very important that we focus on creating. And to your point in value and valuation, that's where the real difference sits. If you want to create long-term value, you have to stop obsessing about valuation.
The best definition of valuation I heard was, it's either a wag or a swag. So I said, what's the wag? Wild ass guess. I said, what's the swag? Scientific wild ass guess, which is you put some numbers in and then you say, okay, this is what the valuation is. I have not found anyone who can actually tell me why, which is in the private market, right? Whether it is a startup. You look at it. Oh, we bet on the founders, not on the idea, right? For early stage. Then we bet on the TAM, okay? So it's really, I don't think there is a formula in terms of valuation. There is a lot of FOMO that creates valuation, in the market, right? I had founders who called me and said, Latika, I've got 40 term sheets. And I'm like, wow. And what advice can you give me? My advice was, please be careful about whom you're taking the money from. It's okay for you not to get the highest valuation because you want your investors to be with you, not the ones who are looking to churn you up, right? To just push you towards valuation. So I think that's really the whole part of the valuation, and from whom you're taking the money is absolutely the most critical part of who is sitting on your cap table and that board meeting. I've been through the pain, and that's the biggest advice to say, don't worry about the valuation, but be very careful about who is on your cap table.
Got it. I think since the goal for today is finding who's at fault, in that vein, and she brought about the founders, how do you, in the current environment where asset prices are going to go up, everything of running the business is going to also go up with the current inflation, multiples are going to remain muted, how do you find those founders who would eventually not do so well? What kind of diligence processes would you use to figure out the companies that would do well versus who would not? What kind of
So in our case, given our stage that we do pre-Series A, Series A, we're, and we are investing in the boring guys, right? So we do have a lot of revenue. We have, by a lot I mean million, 2 million, 3 million, right, which is quite low for Mohan. But you can start seeing trends of how companies, customers are engaging with that product, right? With that opportunity or with that company. Are they expanding their revenues? That matters significantly for us. Are they repeat? Are they expanding? Are there more users coming from the same customers? That for me is a very key diligence point, because we can't be masters of everything, right? We need to learn from the data, and that gives us a lot of information on how this is working. We do a lot of customer diligence, which while we were talking about the commercial diligence, what we do in addition is take these opportunities to potential customers and get feedback, saying, okay, if somebody tells me, hey, this is 50, 60% there, that's good enough for me. If someone tells me I'm not going to touch it with a barge pole, I'm like, okay, great, that's also great input for me, right? But having said all that, I think the most important aspect that we want to see in founders and look for in founders is how insulated you are from the FOMO and the fluff of the world. How logical is your ask? If you tell me that this, very specifically how you will use the funds, right? I will do my own sensitivity analysis on your projections. You will say, I'll do 100, I'll assume it's going to be 50, right? And will it make sense if that works? But if you've done that kind of homework, if you know what your path is, if your ask from a valuation perspective is not related to, listen, that guy down this road on HSR layout got this valuation, so I should get it. That, absolutely is a no-no for me if that's the kind of language that comes. But even more important, which I'm realizing now, because last couple of days I've been here and I'm meeting a lot of portfolio companies, is that the reason you have to cut yourself out from the noise is this fear of, oh my God, recession is here. And Prasanna, to what you were saying, let's keep cash now for whatever period. If you're going to now leave your path of growth and you have this 2 million in the bank and you just want to keep seeing it for the next 24 months, that also doesn't make sense. Right. You have to make wise investments. Again, don't burn, invest. And we are all here to make sure that when, in 6 months or whenever you start feeling that, okay, I don't have that much, I've shown some growth, that's what matters. So people who are going basis the noise, the fears in the market, the FOMOs, that doesn't cut it at all for us. We like to, as investors, we all often say that there's a big gap between the founder's vision and the investor's imagination, right? He's trying to do something. Too early in the conversation, if I say, you should do this, the guy's here to take money from me. He's saying, yes, I will do this. But when he actually goes down to do what he's got to do in those 3 years where I'm, say, high-touch investor with him, he's actually following his path. So my goal is really to understand them in the first 2, 3, 4 meetings, and I sign on to his path. Don't make him sign on to your path. So again, those are things in science that we look for, saying that if we like the founder's path, that's where we participate. Yeah.
Got it. Mohan, I would like to have your closing remarks on this. How do you find the companies who win through inflation? Is the era of growth at any cost, not looking at my bottom line, just focusing on growth, getting more customers, is that era for the Indian startups over in the current environment? Or, do you have an alternate point of view?
See, there are two sets of companies. One are global companies. One is created for the Indian market. So there the inflation is picking up and the ability to pay is pretty low, right? So there you need to marry technology with operational excellence. Okay? Just picking a few names. I won't pick names. A few companies which raise tons of money. They raised money, they neither had technology nor operational ability to execute, right? Moving 0.5 percentage points, okay, in terms of your bottom line. India is very difficult, okay? If you're catering to the Indian market, whether it's selling insurance, selling to Kirana stores, selling used cars, right? 0.5 percentage point is very difficult. So you need deep execution ability, right? Dirty your hands, go see the different operations, see what is happening in the field. So that's very important. And technology is important for you to create a moat. Okay? So we look for business which are this, and any business which we invest, we say create technology mode, but operational excellence in improving your bottom line. So we have teams in-house which are specialized in it to help the companies on both aspects. End of the day, there is no magic answer, right? For investors, money grows on trees, right? It's like, you know what, a lot of money, well, you ask them where the money is coming from. See, if you ask a deeper question, right? Money we raise, I know it's coming from pension funds of teachers and policemen around the world. Okay? I can't come and say, I have tons of money, I'm going to throw it, 100 million I lose, I don't care. Okay? Go and tell it to them. Okay? You know what, I took money from you indirectly, and all I have blown it up and saying that 100 million doesn't matter. Okay? So I think the free money and where the money is coming from, the investors have to answer. Okay? Okay? Not just to raise tons of money, I don't care about few investors blowing up. Okay? It's a corollary, yeah.
Got it. Interesting. I think our times are also up. Times is up, and we had really good thoughts. I think we can keep debating on this and keep creating more conflict, keep finding whose fault it is, public, private. But for today, I think thank you so much for joining us.
Thank you.
Thank you.